Dennis, Lisa wants to talk about bonds. I want to talk about hydrocarbons. You know, they're out of control in Europe. They've got a modest matter of a war. Are we going to see methane, natural gas? Are we going to see different forms of gasoline in America surge like electricity in France?
Probably so. Propane's probably going to go a lot higher. Nat gas is probably going to go a lot higher. Inventories are extremely limited here in the United States. They're unbelievably limited in Europe. If we start pushing nearby nat gas through $9 per million British thermal units, and we're trading about $8.50, $8.60 per million British thermal units, if we start moving through $9, you start to go back to where we were in 2005, 2006, and 2007 when we get to $13 per million British thermal units. So you have to be very careful. Things are very tight and likely to get tighter. So it's not a pretty sign out there right now.
And you're talking about natural gas, Dennis, but you could also apply this to certain oil inventory reports. There are some different ones. And I wonder how much we are fragile heading into the winter to see a spike in oil that could reverse some of the optimism about the disinflation that we've seen in this week's reports.
Keep an eye on the term structure. That tells you more than anything else about what goes on in crude oil specifically, especially a storable commodity such as crude oil. We're in a small backwardation. We were at a larger backwardation a month and a half ago. The backwardation has narrowed, but in the past couple of days, as prices of crude oil have fallen just a little bit, we got WTI down to $88 per barrel the other day, and the nearby backwardation began to widen marginally. Backwardation is where sophisticated and informed money leaves its footprints. And if the backwardation starts to widen a bit, we're going to start seeing crude oil start to go higher again. So I think you've seen most of the decline in crude oil predicated upon a decline in driving miles here in the United States and a decline in demand for gasoline and diesel. I think you start to see at $88 a barrel. That's probably the low, and I bet we trade 95, 96, 97 in the not too distant future. So keep an eye on the backwardation. A widening backwardation is always bullish for the crude oil market.
Wow. So let's transfer that, a $95, $96 barrel forecast here into your projection for the economy for markets, especially because a lot of the trading activity has hinged on this lower oil price. How much does that reverse some of the gains that we've seen in stocks and send yields higher?
I'm afraid that we're seeing the low on yields. We're going to see the much higher prices in yields, much lower prices in bonds. You had something that occurred last week, which I think not enough people are paying attention to. You had an outside reversal week and an outside reversal day in the long bond future. Very rare circumstance. We've only seen it one time before this year, and we've only seen it 2 or 3 times in the course of the last 5 or 6 years. When you have an outside reversal, I pay attention to it. It's one of the technicals that I pay a great deal of heed to. And an outside reversal week is a very rare event. Probably means lower bond prices, probably means higher yields over the course of the next several weeks, next several months. Be careful. And I think that's the decline that we've had in the long bond yields over the course of the last month and a half was predicated upon a decline in inflation, decline in crude oil prices, decline in grain prices, decline in livestock prices, a decline in copper prices, and all those seem to be turning around and turning back to the upside. So be careful up there. Keep an eye on gold. Okay. If gold starts to get to 1825, the game changes completely.
Well, Dennis, we know the story in the first half of the year was when yields go up, it's bad for the equity market. That is why we saw growth stocks underperforming to such a degree. They have staged a pretty remarkable comeback over the last month. Is essentially what you're saying. If yields are going higher from here, that's not going to last much longer.
I don't think it lasts much longer. As the chairman of the University of Akron and Dan and I got us to move a good 14 or 15% of the portfolio out. We got very lucky. We did it on December 31st. And as I've always said to everybody, in a bear market, he or she who loses the least will be the winner. We've lost less than most other endowments. We have a meeting next week, and I'm probably going to say we need to reduce our exposure just a tad more.
You're going to reduce equities. You're going to reduce equity exposure even with this ginormous rally we've seen from June 16th, Dennis?
At the margin, probably another 1 or 2 or 3%. Nothing dramatic, nothing extraordinary, but I think the rally has been a rally in a bear market. The volume has not been as illustrative or as dramatic as it should be on a move to the upside. And over the course of the past 6 months or 7 months, volume seems to come in on the downside rather than on the upside. Another technical circumstance to pay attention to. So my position will be that I'd like to reduce our exposure just a tad. Whether I can get the rest of the committee to agree is another story entirely.
Then what do you do with it? What do you do with the rest of it? Buy options on the Cincinnati Reds, or do you go into cash? What do you do?
It was a good game last night watching the Cincinnati Reds, but I think cash is probably not a bad place to be. In fact, I think cash is a very good place to be. Cash being 2-year bonds and under, 2-year treasuries and under.
Dennis Gartman.
Yield curve's going to continue to invert. It's been inverted for a month and a half.
Yep.
It's probably going to. I think the 2s versus 10s gets to 80 basis points without too much difficulty.